It's a new year. Happy New Year, January 2022. Our fiscal and economic issues discussion group. And we've got, I think, mostly good news to talk about today with a couple of caveats on that. But we're about getting the facts so we can use those facts to sharpen our arguments when we talk to friends, neighbors, blog, comment on an article on Facebook, whatever, communicate to your audience, tweet, or what have you, but give you some facts, give you some ammunition to use. We're going to start, like we most of the time do, by talking about the labor market. And as we can see, this is from January of 2020, or maybe slightly earlier than that. But in March and April of 2020, as reported in those months, it was actually mid-February to mid-April, we lost over 22 million jobs. And we still haven't fully recovered all of those jobs, although we recovered all but about 3.6 billion of them. And some of that lack of recovery is that we have perhaps 2.5 million people who've decided to retire early. They lost their jobs and decided not to come back. So as the comment says, one Fed governor estimates that we're within 1 to 1.5 million of peak employment. I'd like to see us this year get back up above the prior peak from February of 2020. So in December of 2021, which is the last month that was reported, we're at essentially 149 million jobs. We added 199,000 jobs that were reported for the month of December, but with revisions to October, November, we upped the total number of payroll jobs by 340,000. And this is, when we talk payroll jobs, it is not total employment. So it does not include your Uber drivers, your Lyft drivers, your people who are nannies or otherwise employed in non-payroll jobs and get 1099 forms to report their income. And while only 199,000 jobs were reported over on the payroll jobs, if we look here at the total employment from the household survey, we see a much bigger number for November to December of adding 651,000 employed. And if you look back October, November, you'll see that employed actually went up 1.1 million. So we've gone up like 1.75 million jobs. And number of people reporting that they're employed in the last 2 months. And the labor force is growing. It grew, decent level in November to December, and substantially in 500,000 or 600,000 from October to November. The number of unemployed went down 483,000. The overall employment to population ratio improved a little bit, but again, 10,000 people a day turned 65, and all the people over age 65 are counted in that population. So I would expect that those ratios, employment to population, participation rates, would continue to trend down over time, just because of the aging population. But again, the better news in the household survey than over in the payroll survey, but not bad news in the payroll survey. Unemployment rates, again, good news. They went down substantially in December versus November. The U3 rate, which is the most commonly reported rate, is down below 4%. At the beginning of the year, I think they were forecasting it wouldn't get below 4% for a few years. I don't know if David, if you recall what they were talking, 2025 or something like that. But but we got there much, much earlier. The U6 rate, which includes people who, the U3 rate includes people who aren't working, who are looking for a job and have looked for a job in the prior month. The U6 rate, if you're looking for a job, aren't working, but have looked for a job in the last year, or you're working part-time but want a full-time job, you're counted as unemployed in the U6 rate. And just to make it look a little better, they revised the January 2021 unemployment rate up from 6.3 to 6.4%. So it's now going down 2.5% in Biden's first 11 months. For those of you who remember that it was a different number last month, yeah, it was. Employment to population ratio of 25 to 54-year-olds is not a bad thing to look at, because for the most part, it takes out of the calculation people under 25 who tend to be students, or people over 54, which picks up a lot of retirees. It's not to say there aren't any students in that category or very early retirees, but they're not a huge percentage of that population. We're still down about 1.4 percentage points below our, pre-recession peak, which is about 2 million workers that were down in that prime working age population. So again, we were down about 3.8 million workers total. If we can pick up the 2 million that were here, and maybe there's been some growth in this population, pick up a little more than 2 million, we may be able to get back to a new record for payroll jobs. These are some notes that the Bureau of Labor Statistics added during the pandemic to pick up the, substantial percentage of the population was teleworking. This was especially true in the second quarter of 2020. This has been coming down. People who reported they are unable to work because of COVID. And, so these are some notes to be aware of. We're still down, again, payroll jobs are down about 2.3% below their pre-crisis peak. That's that 3.8 million. And as this says, there's been population growth in that time frame. So the size of the jobs deficit could arguably look even bigger. We were counting for how many positions might exist today if the COVID recession hadn't happened. Some people are still out because they can't get childcare, especially with kids under 5 not being able to be vaccinated. There's some people who are not really wanting to be childcare providers for people who are not vaccinated. And again, the early retirement's about 2.5 million above trend. So there's, some concerns as to whether or not we'll get back to how soon we'll set a new record for employment and payroll jobs. But I think we're headed in that direction. The federal budget. Again, fiscal years run from October 1st to September 30th. So President Trump budgeted fiscal years 2018 to 2021, because fiscal year 2021 actually started in October 2020, about 4 years, 4 months before Trump left office. And Biden is budgeting fiscal years 2022 to 2025. What we see here, color-coded, red is Republican president budget years, blue is Democratic president budget years. We see that the budget deficit is forecast to decline substantially in the current fiscal year. And this takes into account the American Rescue Plan, which was passed last March. It doesn't take into account the jobs plan or the infrastructure bill, and it is expected to add something to the deficit. But as it said here, that's about $25 billion a year. So on $1 trillion deficit, it's a rounding error. I mean, it's a big number, but it's not a big number. We're going from a $2.8 trillion deficit in fiscal year 2021 to a forecast for a $1.2 trillion deficit in fiscal year 2022. One of the reasons why we need to convince certain folks that, they're worried about big deficits causing inflation. Well, we're cutting an awful lot of the deficits. So if deficits were actually a cause of inflation, then inflation should be coming way down because the deficits are coming way down. If Sarah's still here, we're sorry you have to leave. And again, the baseline budget projections, revenues are going up. And revenues have gone up from fiscal year 2020. But spending's coming down. If you look at the anticipated outlays, we're looking at a $6.8 trillion in spending in fiscal year 2021 and $5.5 trillion in fiscal year 2022. So coming down by about 1.3 trillion, which is why I think I claim it's going to go down by more than $1 trillion. Because even with the infrastructure bill, even if Build Back Better got passed, it would still go down by about $1 trillion a year. This was a forecast for 2021 because the actual, I think as we point out up here, the actual was 2.8 trillion. This is the forecast for last summer. We will get a new forecast from the Congressional Budget Office, the CBO, sometime this quarter. Typically they come out in January, but sometimes they come out in February or March. So we'll just have to see when they get around to doing it, when they feel comfortable enough that there's not going to, Build Back Better won't pass. And so they'll do their analyses without Build Back Better, or some version of Build Back Better passes, and they'll do their analysis, including that version. The economy regained its pre-crisis peak during the second quarter of 2021. The GDP tends to recover faster than jobs. If we go back to the Great Recession from the 2000s, where we lost a lot of jobs and stopped losing jobs in early 2010, GDP had recovered in 2011. Jobs didn't recover until 2014. So it's not surprising that GDP recovered last year in the second quarter, and jobs may recover this year or may recover next year. And as David pointed out to us, among others, that goods and consumption of goods is the prime component driving GDP growth. Services are actually down. And because the strong demand for goods, that's a driver of inflation of the price of goods, as well as the supply chain bottlenecks, which haven't been able to adjust quickly enough. We talk about the backlog at the ports, but the ports are actually, receiving and transferring more product than they ever did. But the problem is that we want them to do even more. And to the extent anybody have questions, feel free to put them in the chat or speak up. Freight activity is about 20% above the 1990 base year and the upper range of the past 5 years. We're looking at it here back in 2018. We're above 2019 and 2020 pre-recession, but there was a peak in 2018 that was a little higher. And the cost of shipping a container from Asia to the West Coast has gone way, way up versus where it was. If I'm reading this correctly, it was about $1,500 2 years ago, and it's now at about $15,000, which is kind of a driver of inflation if it costs more to ship stuff. If we look at the month-to-month change in the CPI for all urban consumers, This is the one that was reported the 12 months at 7%. It's kind of all of these individual months. And we see that it's been trending down over the last 3 months. But on the other hand, it was down in late summer and bounced back up. As we get more months, if the next month was again at 0.5, we're going to roll off the 0.3, and so it will go up slightly. But in a couple of months, if it's at 0.5, you're going to start to roll off. Included in that calculation was 0.6, 0.8, 0.6, 0.9. And so at that point, we may see the 12-month inflation number coming down the middle of this year, I'm sorry. Big causes of the 12-month inflation at 7% and the core inflation at 5.5% is energy, like gasoline, and used car prices in the 5.5%. Food is up in the overall 7% number. It's not nearly as big a factor as the energy prices. And we can see where energy prices, gas prices are up almost 50% year over year. Used car prices are up almost 40% year over year. So these are some of the big things that are pushing it on the year over year factor, although energy prices dropped in December versus November. So they tend to pull the inflation rate down a little bit versus where it might have been. And David understands this better than I do, but there's certain bonds that are inflation protected.
No, you've got it. I mean, the good news here is that when it's these different kinds of bonds, one's inflation protected, one isn't. But one nice thing about it is that this is off its peak, meaning we came off of this November 15th reading, the red line getting up over 3%. The Fed watches this pretty carefully and gets nervous when expectations start to go through the roof like that. And I think by announcing that they were looking at pulling back some of their bond buying programs and possibly raising interest rates or likely raising interest rates next year at different points, that sort of knocked those numbers back down. And now they're sort of working in this range around 2.8. So let's hope they stay there. But if they do jump again, that's when the Fed will more likely take stronger action. You know, not just see the Fed. Think of it this way: as the Fed buys these bonds and they add to their balance sheet, they've been doing that a lot. They can slow down the buying, so the balance sheet is still growing, but growing more slowly, or they can actually stop for a while and let those bonds mature and run out, or just keep maintaining a certain size of the balance sheet, or they can actually let the balance sheet fall. So there's a lot of room for them to act, to slow down their bond purchases or stop them altogether. And then they can decide to actually reduce the size of their bond holdings, which is a way of slowing down the economy. And then they can actually raise interest rates. They may not have to raise interest rates at all if they slow down their bond buying enough, but they may want, we'll see what they do, what they feel is necessary. But, one thing about inflation is all these prices, 2020, we had prices actually fall a little bit. For the first half of the year, prices were falling on average. And now they've been coming up. We'll be comparing in the back half of 2022, we'll be comparing against the higher 2021 prices. The prices were really, the inflation started to accelerate in the back half of 2021. And so you're going to see an apples to apples comparison of higher prices in 2021 and higher prices at the end of 2022. That's when we'll see these inflation numbers likely falling, because you're seeing a comparison against the higher price. So just a couple of things to think about that the Fed's going to be looking at here, and they watch these expectations very carefully from investors.
And here's
I can continue if you want.
Yeah, go ahead on this one.
Okay, so this is an interesting article that Paul Krugman did a little while ago, and he talks about, because you've got this large surge in demand for goods, that's where we're seeing more inflation. So the upper part is showing the goods demand and how much it's jumped. So you can, the index of 100 is sort of a starting point. So he's got 100 there at the sort of pre-crisis January 2020, right before that gray line is where the 100 mark is. That sort of is the starting point. And so goods are up somewhere around 20%, personal consumption expenditures on durable goods up almost 20%, but services are still a little below where they started, below that 100 mark. And now he's looking at, and that's the upper graph. Lower graph is showing the inflation, which is also mainly the blue line. I mean, the red line isn't that far off trend. I mean, it's still that sort of same shape that it was, but you can see that blue line has gone a little crazy. Things had been deflating for a while, and then they jumped. And so goods have sort of been catching up over a period of time. I've told the story before that I bought a car, the same model car, 14 years before, was it like in 2002, and then I bought the next model in 2016. They were the same price. And there's a lot more gadgets in the new car than the old car. So 14 years, the car served me well, and the prices were the same for the car, even with new quality improvements and other things that were jazzed up in there. So you see a lot of that. You saw, goods. The goods and services are a really handy way to look at the economy, because the goods have been deflating while the services have been, well, in the past, the goods had been deflating while services were inflating. Now you see the flip side of that. The services are kind of doing the same thing they always have, but the goods have really been jumping, and that's what's driving these inflation numbers. And Krugman's analysis here, you can read it, but he's saying you've got a huge demand, a spike in demand for goods. You're seeing a spike in the prices because we can't produce. You're not getting the stuff. How would I put it? It's not that they can't produce it. It's harder for them to produce it. They are spending more money to produce. Think of it as almost like overtime in the factory to get the stuff produced. It costs them more to produce it. Also, some of the inputs have been in shorter supply, so they're paying more money for those inputs like chips and some other pieces. And so we're hoping that if you can produce the chips as people return to the workforce, because right now a lot of people are still out because of COVID, they come back into the workforce, that eases that supply problem, and you see those bottlenecks, those supply constraints go away. And so Krugman has said, and I was wrong too. I mean, we both thought that the inflation thing would be minor and wouldn't really take flight, but it has. So now Krugman is saying, I was wrong then, but I do think that inflation will slow down quicker than others. There is a school of thought that inflation will continue to worsen. I'm in the Krugman school, which is that, yeah, I was wrong before, but I think that the inflation is not going to, it's going to slow down in the second half of 2022. I actually think, somewhat a contrarian view, we may see deflation, meaning we may see negatives in those numbers. That is not the typical viewpoint. The usual forecast is for just the inflation rate to slow back down toward 2%.
I think certain commodities like, gas at the pump or crude oil may come down a little bit, but I don't think we'll see deflation generally. That's just me. The other thing that we're seeing in terms of the availability of goods, and I get this because my sister's in Vietnam, is that as they're getting, they had factories close because they didn't have workers that they could have work in the factories. Now that they're getting vaccinations and vaccines in those Asian countries, they can get the workers back in the factory safely. And so that's helped on the production side.
Do you want to go back to it, Carl, or I can go on either way?
Well, I can take this over. This is talking about inflation over 2 years. So we talked about inflation over 1 year being at 7%. Inflation over 2 years is at 8.5%. So the prior year was about 1.5%. So if you look at the average inflation over the 2 years, the average annual rate was 4.3% for the CPI and 3.6% if we exclude the more volatile food and energy. And so what this is saying is, yes, inflation is up, but the 7% is a function of that 1.5% in the prior year. And then this is that since February of 2020, wages have gone up faster than inflation. So there are periods during this time where inflation is, and perhaps recently, inflation has gone up faster than wages. But overall, since the pandemic started, wages have gone up a little bit faster than inflation, which is why people have money to spend. Most people have money to spend. And we have that demand for goods because we can't spend it on services. And the producer price index is one that busier graph than I would have liked. But in any case, it's this is the producer price index, the final demand, and then separated into goods and services. But what this is showing is that final demand for overall, the producer price index in December versus November only went up 0.2%. If this trend continues, and this was, not an anomaly, and we get these kinds of relatively low numbers for the producer price index in coming months, we will go ahead and have, inflation should come down fairly substantially in 2022. The other thing to note on this graph is that the highest month for the producer price index overall was President Trump's last month, January of 2021. That is a Trump month because he was president until the 20th of January. Next month on the producer price index, if we get a January number, we're going to add in whatever that number is. We're going to take out this 1.2% number. So we should see the PPI coming down fairly soon, unless I'm totally wrong. And I have been before. This is what I'm talking about in terms of this is that 1.2%, fairly high through the summer on the producer price index. Came down for a couple of months, bumped back up in November, and then came down in December. I think this was energy prices peaking, if I recall correctly. And then what we see here is that in December at the producer price level, food came down, energy came way down. And so we have, not counting food and energy, things went up a little bit.
And just to add to this, that producer price index is what the prices that companies are charging. Not the way, and it's you would think it would be the same thing, but it's not. The consumers are paying a certain amount, and then the prices that companies are charging. And could you go back a second, Carl, to the first page on the PPI? I want to make sure I've got that right because I'm learning this. The first page.
How far do you want to go back?
One more up. There you go. That's it. Yeah, the measure of the prices received by sellers of domestically produced goods. Okay, so yeah, so it's the prices, and so if those are starting to fall, you would think that what consumers are going to pay would start to fall. You would think they go together, but at least the way they measure it, they're not the same. And I don't know if you have more background on that, Carl, but that's one of them.
There's a lag,
sort of like,
certainly.
Yeah, go ahead.
If the price of a barrel of crude oil drops, that doesn't immediately show up as the price at the local gas station dropping. Although for that particular commodity, it does reflect it fairly quickly, especially if the price of crude oil goes up. But on other goods, they've got them manufactured, and you've got a cost of the inventory, and they don't automatically adjust prices all the way through the sales structure when you have an uptick or a downtick at the front end of the production.
This may be a leading indicator for inflation trends.
Yeah.
It's in front. Okay.
And what can fiscal policy do about inflation? And generally, not a whole lot. Because I think it was Friedman who said it's generally a monetary phenomenon, not a fiscal phenomenon. But
that might normally be true, but I would say this one's a little different.
Yeah.
At least in the short run, I would totally agree with you that it's hard for fiscal policy to do a lot in the short run. and it's certainly, the history recently has been the Fed controls, the interest rate. The Fed is in charge of the money supply and has a bigger toolkit, if you will, or better toolkit for inflation. But in this case, we have supply constraints. We also have a massive demand boost because of the amount of money that was put in people's pockets through these relief measures, not just the Biden administration, but also during the Trump era. So you've got a weird situation where demand for those goods may be a big driver of that inflation. And so if you reduce the budget deficit significantly, meaning you don't keep giving people the checks, then you'll see the inflation drop off because you'll see the demand drop off, and the difference between the demand and the supply will be less. The price won't be bumped up as much. So normally I would 100% agree with Carl, and Christine may have a view of this talking about MMT. The MMT philosophy, and Christine can correct me now or later, however she wants to do, but the MMT idea is when the government spends money, it's injecting it into the private sector. And when it taxes or stops spending, essentially, it's taking money, it's either putting money, it's taking if it stops spending or reduces spending, it's essentially taking that money out of the system. Technically, the taxes are taking the money out of the system. So by reducing the budget deficit dramatically, which we are, as Carl mentioned earlier, you're going to see a lot of that demand come out. You're going to see a lot less additional money being put into the system. And that should, in theory, slow things down. So we may have kind of an MMT experiment going on where the fiscal policy has a lot more to do with inflation than normal, but we will see. We'll see because, and we'll show you a slide here in a bit, the consumer bank accounts are way up based on all these recovery acts and the priors, the CARES Act and others, but they are coming down. And so a lot of that excess demand, if you will, is being drained out of the system because people have spent the money. So we'll see what happens, but I just want to put that counterpoint in there, and that this may be a scenario where a giant reduction in the deficit may have a substantial impact on inflation, and we won't know that for a year. We'll see it in the back half of 2022, what's really going to happen.
Well, we really won't know it, period, because at the same time we're reducing fiscal stimulus, the Fed says they're going to reduce monetary stimulus.
Right. It's not, and you can't disentangle the two. That's a good point. Yep.
But hopefully the combination of reducing the fiscal and the monetary stimulus will reduce inflation by the second half of 2022. So we'll go into the midterm elections with much lower inflation numbers. Something under 3%, I think, would be a great target. I mean, we've talked for a long time, since back in 2020, the economic recovery to a great extent depends on a reduction in the COVID cases. And because that would allow people get more comfortable going back out and getting services, it'll pull the demand away from goods, and the inflation pressure on the goods should moderate. We have an experiment with that in Chicago and Cook County, where we're saying that if you want to go eat in a bar or a restaurant, you need to be fully vaccinated. And for me, that means I'm more likely to go out and eat at a bar and restaurant than I would be if we didn't have that rule. Because people pull their masks down to eat and drink. And what the Tribune has reported is that on the north side, the more heavily vaccinated wards, bar and restaurant business has picked up, or on some places on the south and west side, where the much lower vaccination rates, they're having a lot more pushback against the vaccine rules. And this is something that it's worth looking at. The vaccine effectiveness is not just, I have a vaccine, so I'm protected, but it's also the concept of herd immunity, so that if enough people are vaccinated, if a new case shows up, we don't get many new cases, breakthrough cases, whatever, because there aren't people that it can spread to. This was an article that I quoted back from 2019, which was pre-COVID, just talking about the nature of herd immunity, and that for herd immunity for measles, you need 93 to 95% of the population to be vaccinated. Christine was telling me earlier that the R naught of measles is something like 18, if I'm remembering that correctly. Or the R naught for the even the Omicron version of COVID is more like 6, 7, 8. So we're not quite there, but we need to be up in the 80% range to be blocking, Omicron. And obviously we're more like low to mid 60s, I think.
Does the herd immunity idea still apply if people are getting the virus?
Yes.
Like if it's punching through the vaccine, how does that fit into that?
Well, it doesn't, it punches through the vaccine, but it punches through at a much lower threshold. Somebody on this meeting posted a tweet earlier today, I think I saw, about how people who were fully vaccinated were like, got about, on a per capita basis, got about 10% of the cases that the not unvaccinated got. Not as many people will get sick. And the fewer people that get sick, you slow down the spread, and hopefully you get that R naught with the vaccine down below 1, and it goes away.
You're very unlikely to get reinfected
Yep.
by Omicron, right? Because your body's already built up an immunity to it and it's still active. That's why you get the huge surge, and it appears we're getting a very large fall off. So that particular strain is going to go run through its course and then pretty much go away. The trick is, let's try not to breed the next version.
And David, if you want to take this, it's
Sure. I mean, this data is from mid-October. It's the latest one I could find. About 90% of the Democrats are vaccinated, have had at least one dose, and about 61% of Republicans have had one dose. And there are a variety of other items in here. If you're interested in digging into this, it's the Kaiser Family Foundation. The source is, it's hidden on my screen, but it's down at the bottom of that chart, shows the source. And, it also mentioned that among Republicans, the younger Republicans and the lower educated Republicans were the more likely among the Republican population not to be vaccinated. So younger and less educated, less likely to be vaccinated. However, an interesting thing was in there, which is that partisanship has become the number one factor in vaccine uptake, meaning that other factors like lower income or rural versus urban or education level, all those other factors bear on this, but the partisanship is number one, which to me is amazing. That people they take a political stance on a vaccine just blows my mind. Now we should be used to it, in hindsight. I mean, over the past couple of years of this, we've gotten a little bit used to that. But that, if you would ask that question, or if that had been something that nobody would have expected, I think 10 years ago, that a vaccine would become a political statement one way or the other. I don't know, maybe there's people here with better sense of the medical history where that may have happened before, but I've never heard of such thing. I could imagine not being able to reach poor people that don't have as good a care as rich people, but that is not, and that has affected the situation here, but it's not the main driver. It's this partisanship, which is the main driver, which just is amazing to me.
Well, I don't know that it was political, but Christine and I were talking about a few years back when there were measles outbreaks and, in unvaccinated groups. And it was, Orthodox Jews in Brooklyn and Hollywood types that were the groups that had the unvaccinated kids who were getting sick with measles.
what were the Hollywood types thinking? What was going on? What's up with that?
I don't know, isn't Jenny McCarthy one of the leading spokespeople against vaccines?
Wow. That's amazing. I missed that one, but okay.
Yeah.
All right, you can keep going, Carl, if you want. So I heard you guys talking during the break about how the media tends to focus on the negative. And we covered a lot of these statistics. I mean, when you see a 3.9% unemployment rate, I mean, historically, that's incredibly low. You've got 11 million jobs open. If you want a job, you can get one. Maybe dangerous. You may be risking COVID, but you can get one. There is GDP is already at a record level, and it's expected to grow very quickly this quarter, as we'll talk about. So this is there are so many great variables right now that you could brag about as a Democrat, with the exception of inflation. And that's painful, and it's getting an enormous amount of media attention. There is a ton of other stuff that's going on well in the economy. One other element I'll mention is, we don't talk about it enough, is the stock market was up. Biden set a record actually in his first year. And we'll talk about that when we get into the year one review, but the market was up 37% from a year after Biden's election. And the stock market's kind of a leading indicator, so it tends to move a little bit sooner in anticipation of things, and it 37% in Biden's first year. So America is by far the richest it's ever been. And yeah, it's not all equally distributed, fair enough, but there's a lot that Democrats could be talking about. So we'll get into some of those. So if you are president and you come into office in 2021 and you see a forecast like this, 5.5% growth expected in the current year, and then 4% in the next year. Those are amazing numbers. I mean, anything above 3 is a lot. Anything above 2.5, you should be happy with. And 3, 4, 5% growth is enormous. And bear in mind, we're at a record level now. We're not in a recovering GDP. We're already at the all-time record high GDP as of Q2 2021. So this is growth on a record number, not growth. Well, the 5.5 is a little bit of both, but the 4 is on top of, will be entirely on a record level. The unemployment rate going back down, it's already at 3.9, going down to 3.5 and staying there for 3 years. That is an incredible thing. You're going to have full employment for the next 3 years. Inflation falling, getting cut almost in half next year, and going back down slowly to 2% over that time. Phenomenal. And then the core PCE, same thing, another inflation measure, also on the same trend line. And the federal funds rate historically coming up, but still very low by historical standards. If as a president, you could come into office and ask for an incredible economic forecast, this is it. You'd say, well, I don't care for the 5% inflation here. That's bad. But look at this. So there is so much material here that the Democrats should be advertising. And that's one thing we hope everybody on this call does, is you have the tools here, spread the word, and to some extent, Carl and I, as we put these presentations together, we'll give you some links for even doing that if you really don't want to do this yourself. But you can always cut and paste this stuff easily into Twitter or into Facebook, or share it wherever you do. You email your friends, whatever you like to do. But this is a tremendous economic forecast right here. This is another one, just breaks it out more by quarter. Last one was the Federal Reserve. This is Wells Fargo. And so here, they're expecting an 8% growth in the fourth quarter annualized. Again, that's annualized. If the economy grew at this rate for a full year, it would grow 8% in that year. This is, let's divide that by 4, that's 2%. That means they're thinking the economy is going to grow in physical size about 2% in one quarter, which is almost like a normal year's worth of growth. That's what that 8% means. And then that'll fade down to still be above 3% for each of the quarters next year, and still end up with really solid numbers for the next couple of years. Inflation will not peak until, actually they're saying in this first quarter will probably be the worst of it, and it'll start to come down. And then the interest rates will rise slowly. Mortgage rates will still remain very low, below 4%. And it's no fun to be a bond owner. You're still going to get a lousy return on bonds. So one of the reasons why the stock market has done as well as it has is because you can buy a stock that may go up and pays a nice 3 or 4% dividend, or you can buy a bond that is paying 1 or 2%, and you're basically giving away your money because inflation is faster. So given that choice, investors are buying stocks. But this is, again, an incredible forecast to have. This is a
comment on one of Bill's statistics, which was false advertising, but it, but you know, the Republicans talk about we had the greatest economy ever under Trump in his first 3 years, and we added 6.6 million jobs over those 36 months, from January of 2017 to January of 2020. In Biden's first 11 months, we've added 6.2 million jobs. And if we bounce back up to his average job growth of 500,000, we will have added more jobs in his first year than in Trump's first 3 years. Now, Trump's fourth year was such a disaster that his total for 4 years was a net loss of 2.8 million jobs. But
it's been a while since I looked at the numbers, and Obama's last 3 years and Trump's first 3 years before the crisis. So the best of Trump's 3 years, not affected by the decline that we talked about earlier, still the job creation wasn't as fast as the last 3 years of Obama.
Yeah, his first 3 years were 6.6. By Obama's last 3 years were 8.1 million jobs added.
Yeah. I mean, but it tells you something. It tells you how good the Republicans are at marketing. I mean, you can beat up Trump on a lot of things, but he is a heck of a marketer. I give him that. And the Democrats need to learn something from him. You can learn something from good and evil people. And you can learn about marketing from him. I mean, if the stock market were up 37% in Trump's first year, you would have heard about it. In fact, you heard about it a lot when he was up, and I think the comparable number we'll show you was about 20%, I believe, for Trump. And he was bragging about it. So Democrats just need to learn to brag. And because take up that, otherwise you let the media take over the narrative, and we surrender the initiative, and we need to do better. And so you've got some of the tools here for that. And that's where we are, Carl and I, to some extent, are information evangelists. We want you guys to have the numbers and, share it. You got it. Let me keep going here. Thank you for that, Carl. This is a fancy way of saying that the Federal Reserve looks at a lot, because let me step back. GDP information is published quarterly, but there is a lot of information that the Fed is looking at that happens monthly. Some stuff is daily. They've got a lot of other metrics, and they're using those to forecast what they think the GDP growth will be for the quarter. So I gave you this number, 8% right here. And I think 2 slides up, yeah, that one's not by quarter, that's for the full year. So here, 8%, the Fed is forecasting somewhere between 5 and 7.5% in the fourth quarter. And that was as of December 24th. I didn't update after that. They have said, though, it's very challenging for them to forecast this stuff right now. But by their measure, whether it's 5%, 8%, 6%, that is a booming economy already at a record level in terms of the size of the GDP. So that is something to behold. Fed Governor Waller gave a speech recently, and these are some quotes from him. He thinks we're close to maximum employment. Job creation was lower than expected last month, but the number indicated another solid increase in jobs. And as Carl and I have pointed out, they keep restating the number higher. So I think Carl we quoted a 200,000 number approximately, but then with the adjustments, the total went up 300,000-ish over 2 months. Was that right?
Yeah, what was it,
350?
December number was reported at 199,000, but the prior adjustments brought the total payroll jobs number up by about 340,000. So another 140,000 of prior month adjustments.
And that's a pretty solid increase in the number of jobs. And that's what he's talking about here. I mean, 200 is decent. Like that would have been a good typical month in the Obama or Trump era. 200,000 is a good rule of thumb. You're doing all right. And so, but it was 300 something. Accounting for retirees leaving the workforce, which I've seen estimates about 2.5 million. The employment's about 1 to 1.5 million jobs below its February level, before the pre-crisis level. So we're getting close to full employment. 3.9% unemployment is extremely low. Remember that 3.5%, which the Fed is forecasting we're going to get back to, we got to that level before the crisis under Trump. We got to 3.5. That was the lowest level in like 50 years or something. So we're close to like the lowest, like as close to full employment as you can get. So this is a tremendous economy for workers from that perspective. It's just like with COVID, it's a little dangerous to be around other people. That is the challenge. He says the economy seems to be on track to grow at an annual rate of 6 to 7% this quarter, nearly that much in the first quarter of 2022. And then inflation, it's high, it's persistent, broadening out. Wages are rising. And then businesses feel very comfortable passing on their increases to their customers. So you're seeing, it isn't that businesses are cutting into their profits by keeping their prices where they were, they're increasing them, and they're also paying their workers more. And I'll show you in a little bit a comparison that shows the wage increases in the last year are a little bit slower than inflation, but as Carl showed earlier, that slide, measured pre-crisis, wages have actually grown faster than inflation. So this is pretty positive. Note, it's really the same kind of idea. Economy's doing great. It's looking good next year too. Inflation's bad right now, but we're taking steps to get it under control. And this is Raymond James kind of looking at the pros and the cons, saying there's more pros than cons. And they talk about fast growth, a solid labor market, corporations. I'll show you I think I left the slide in here for corporate profits, which are at a record level. The U.S. consumer is very healthy with very strong checking accounts and other balances. Again, net worth is at an all-time record level by far because of the stock market and housing prices. And then the cons are inflation, investors from a stock market perspective getting worried that the federal banks, that the national banks are going to jack up interest rates, maybe go a little too far to get inflation under control. And then, of course, the big one is the COVID mutation that puts people back in their homes again. That's the really, hopefully low probability, very high impact scenario that we want to avoid, and why it's so important that everybody get vaccinated. All right, so forecast looking good. Let's take a look at year one under Biden. And in most of these cases, the way Carl and I do this is Biden's first month, he was inaugurated in January. So the monthly figures that end in January is kind of his starting point. So like the number of jobs in the country as of the end of January, that's where we sort of start the count for Biden. And also,
let me clarify that.
Go ahead. Yeah,
it's
go
not
ahead.
End of January.
Right.
The surveys are taken during the week that contains the 12th of January, which means that the last possible date that's in the surveys is January 18th, and a new president is inaugurated on January 20th. So the employment data all precedes the inauguration of the new president. It's not an end of January number, it's a middle of January number.
That's fair. It is, and that's when they do the survey. It's the numbers that are reported for the month of January for the jobs. That is the number that we start with at Biden. That's his starting point. That's how we do it. And as Carl pointed out, that survey is done in the middle of the month, and those are the January numbers. Like we just reported the December numbers for Biden. Those numbers were reported in early January, and they were a survey done, Carl, like December 12th to 15th, somewhere in there?
The week, I'd have to pull out a calendar, which I don't have handy.
Somewhere mid-month, like mid-month or a little
it ends
earlier.
the Saturday of the week that contains the 12th.
Yeah. Okay.
So it can be no later than December 18th, but
right.
If December 12th was not a Sunday, it would be earlier than December 18th.
So we're using January as sort of his point zero, his starting point. not December, just to be clear. And also, when it comes to the quarterly numbers, like the GDP, we would use the first quarter of 2021 as his starting point and go from there. We're not using December, the fourth quarter of 2020. So just, we'll clarify that as we get into it, just so you know, the starting point isn't always an intuitive year-end cutoff. It's a month or a quarter off, kind of. So this slide is kind of interesting. I've always liked this one. It shows the cumulative increase in jobs percentage during the tenure of the president. So you've got the number of months along the bottom, 96 months that a president is in office, and it shows how the jobs increase throughout their presidency. And so you people probably realize that Carter, in his first term, had the fastest job growth in terms of percentage of any of the presidents, at least going back to him. Anyone from Carter to present. I don't have this going back further in time, but this Biden right now is a hair faster than Carter out of the gate. So as of observation 11, Biden's up 4.4% in terms of the total number of jobs. It's like 6 million-ish jobs, up 4.4%. He's just a hair ahead of Carter. And hopefully that trend will continue. But just to give you a sense of Clinton was sort of the not quite 45-degree line, but just had really solid job creation throughout his administration. Reagan had it in the second part of his administration. And then Obama really recovered from the crisis and then had pretty solid job creation through his second term. So you have sort of these three lines here, Obama being a little bit slower than these other two, but Clinton and Reagan had really excellent job creation once they got going. Clinton throughout his term, and then Reagan, you see a dip here, those bad recessions in 81, 82, and then he climbed out of those and just had a really nice run from there. But Biden is number one right now in terms of the job creation. Now, yes, we are still recovering, but all these presidents, it's an apples to apples comparison. It shows that first month of when they were inaugurated as their period zero and goes from there. Fastest out of the gate. The Biden horse is winning the Kentucky Derby as of month 11. Stock market also set a record for Biden. He had the fastest first year growth in the stock market, S&P 500, measured from election date. So 37.4% from election. So that was like November to November. So this would have been around November 3rd of 20 to November 3rd of 2021. These figures over here are as of 12/30, are comparing against 12/31. So up 41% from election, up 24% from inauguration as of the year end. We'd all be retiring early if we could get a 24% stock market return every year. So we'll take it. Who knows what we'll run into this year. We're down a little bit in 2022. The market's been correcting a little bit here, but we'll see. And as you know, about half of Americans own stock directly or indirectly through their 401ks, and the top 10% own about 90% of stock. So this is really good news for a smaller fraction, but still helps half of America directly. And to the extent that there's a wealth effect where people that are seeing their assets appreciate or spending more, that helps everybody. But for the most part, half of America really benefits from this. And a lot of those people vote. So let's brag about it, These are some other, this is just a quick hit, a view. Stocks up 23%. This is January to December. Inflation 6.8, wages 5.8. So here's what we were talking about earlier of inflation has grown a little faster than wages in 2021. But when you go back to pre-crisis, wages have actually grown faster than inflation. So this was reversed when you go a little bit further back. Jobs are up 4.4%. GDP is up 2.2. And recall, this is something Carl pointed out to me as a way of explaining it. If you measure, this is measuring from Q1 only to Q3 because that's the latest number we've got from the government on GDP. So this is 6 months of growth, 2.2%. That's a respectable full year number. So if that was 4.4, that would be really nice growth. We'll see where Biden ends up. The estimate is somewhere around 5.5 from the Fed. So we'll see. And the unemployment rate has fallen by 2.4 percentage points, which is an awful lot from, where were we? From 6.4 to 3.9. So those are
actually 2.5%. We restated January.
Okay, so now we're two. That's right. It's 2.5 now. So that's a huge drop off, like a third. It's 2.5 percentage points, but it's a third of a drop in that. So that's a very big improvement. And this is where you can see the number. The
David,
numbers actually.
David,
Go
can I
ahead.
stop you for a minute? There's some discussion in the chat. Can you back one more graphic? No, I guess one more. It's the one that showed jobs. Yeah. Because people were wondering whether the Bushes were on there. And you'll see that the Bush 41, George H.W. Bush, is the dotted line there in the middle. And the green line that goes down at the end is George W. Bush.
Yes. So, and you can see with Bush that if he had been in office a little bit longer, because Obama continued that, the jobs went negative, meaning Bush got out just in the nick of time. If he had stayed, he would have been at a negative job creation just like Trump had.
Okay, looks like we want to see the
administration.
next graphic too. The next slide.
The stock market?
Yes.
Or
we see
go
Bush,
up further.
No, go back to the stock market one. We see Bush, the first Bush. I don't see the second President Bush.
Yeah, he didn't make the top 10 here. This goes all the way back to Roosevelt and Kennedy. All the way back to
it's
Roosevelt.
the top 10 going back to Roosevelt and Kennedy.
Right.
Okay.
Yeah, Bush didn't even make it. And here's Trump at 21%. And rest assured, he was bragging about that. Biden's here at 37.4. I have yet to hear Biden bragging about the stock market, although he probably has snuck it in here or there, but I don't know if you guys have. But this statistic was just not covered by the Democrats, really, and they should have been all over it.
Yeah.
Let's take credit where we can. Yeah, okay, sorry. Thank you, Carl, for stopping me. And let me take a quick look at the chat, too. Is there any other stuff that we need to talk about? You guys can always interrupt. Don't feel like you have to just chat, because it is tricky for me to see it as the presenter, but Carl can spot it and stop me a little easier. But you guys, this is a small group. You guys can stop me at any time.
Unmute yourself and speak up. One new message.
That's right. We love hearing ourselves talk, but we like it when you guys interrupt us. It's okay. So here's sort of a detailed table of this, but this is a detailed group. So let's go through what this is. The jobs level, 142 million, almost 143. Now it's almost 149. 6 million jobs, 4.4% increase over 11 months, right? It's not even a full year yet. We'll get that, we'll have the 12 months next month. So just keep that in mind. It was sort of the warning I gave up front. This is from, the end of January, or the January numbers as reported. The unemployment rate has dropped quite a bit. The number of unemployed has fallen by over a third, almost 40% drop in the number of unemployed people. The real GDP's been at a record level, somewhere in the middle here. In Q2, we hit the all-time record, and we're in that record territory now. Inflation is high, no doubt. This is and this is kind of a weird. It's not so easy to sort of just compare these two numbers, because this says in January prices were 1.3 higher than they were in January of 2020. This says in December of 2021 prices are 7.1% higher than they were in December of 2020. So I've got the comparison here, but I wouldn't. It's not. These aren't a real good one to just do a plus and minus with. Wages are up 5.8%. The budget deficit is this is a forecast here. The budget deficit is expected to fall in half, more than half, 1.6 trillion, almost 60%. Stock market's booming, and then the debt is up about $1 trillion, debt held by the public since Biden took office. So that is something that you can be extremely proud of in terms of the economic performance.
I'm hoping more of our Democratic politicians start echoing that, we have a good economy.
Yes, we do. We have we'll take it. Whenever you have 3.9% unemployment, you're in really good shape.
Well, and the other thing to remember is that Trump got to his 3.5% unemployment by pumping up the deficit. We were over $1 trillion deficit before COVID hit.
Yeah.
We'd gone from, 600 billion to over $1 trillion. And so he was getting his growth by pumping up the deficit. And we're planning to get the growth while cutting the deficit by more than half.
I think a really good rule of thumb for fiscal policy, and it's not something we're following right now, or that Biden is planning to follow, and he's not allowed to. I mean, he could ask for it, but he won't get there. Is I think it's always a bad idea to cut the deficit before you've regained full employment, meaning the number of people with jobs is not quite back to the pre-crisis peak. And what's the number, Carl? Are we down 3.6 or so?
3.6, something like that. Well, you're right that
one of the slides earlier.
since the Great Depression, we never cut spending as a percent of GDP until we'd fully recovered the jobs, the pre-recession jobs numbers, until we got to the Great Recession.
Yeah.
Where we cut spending, heck, we cut spending in nominal terms in fiscal year 2010 and didn't fully recover the jobs until 2014. So the Republic, with a Democratic president, the Republicans scream about deficits, and we're doing it. Although frankly, $1 trillion deficit is not a little deficit.
That's fair. That's true. Yep. Yep.
But in fairness, if you look
That
at the
is true.
projections for the deficit, we're going, in Biden's next years, we're forecast to be below $1 trillion.
Is the deficit cut in half because more people are working again and the taxes are up, the income's up?
It's a factor, but we also, we have taken away the extra push on unemployment, the additional $300 to $600 a month
Oh,
on unemployment benefits. We've stopped the, $600, $1,200, $1,400 checks.
Right.
So there's a number of things like that we've cut spending. I mean,
Right. You're not seeing the giant relief packages anymore. I mean, those packages were in the 2020 and the 2021 fiscal year figures. They're not going to be in the 22 fiscal figures, which is what we're seeing here. This 1.1 is fiscal year, it says December, but it's the fiscal year 2022 forecast. This is a 2021 actual number. So it's, this is like this 3 trillion-ish number is what we saw in 2020, fiscal year 2020, 2021, the last two Trump years. This is what we're going to see in the first Biden year. But the point that Carl and I are making is cutting the budget deficit when you are not yet back to full employment is arguably an error. This is a weird one where, is the economy overheating? We've got inflation, maybe we should cut back. But, generally, if it were up to me, I would say, do another relief package until we're back to full employment. But that's not my call. And at least I can brag about how small the deficit is. But from a fiscal policy standpoint, I think you'd be better off maintaining that deficit for another year or two until you're back to full employment.
we'll keep our fingers
the
crossed that the economy continues to grow while we cut the
Yes.
deficit.
Right. I mean, and it's been a few years, but I suspect some of you on the call remember the fiscal cliff. Remember how there was nothing else in the news but the fiscal cliff? And this was the idea that the budget deficit was going to fall enormously if Obama didn't extend, if Obama let the Bush tax cuts expire. So Republicans were worried about the fiscal cliff because Obama, in theory, he had veto power. He could have let the Bush tax cuts expire at all income levels. And there was a whole complicated debate around that. But point being, and the fiscal cliff back then was like $600 billion. Now the fiscal cliff is 1.6 trillion, and it's not in the news at all. Good luck finding an article about a fiscal cliff right now. It's amazing how these things change over time and depending on who's in office, and what's about to happen. If the Bush tax cuts were about to expire, Obama had the power. All of a sudden, the fiscal cliff became a problem. The Republicans were okay was running the bigger deficit indirectly. That's what they were saying. So the fiscal cliff was everything. And the CBO was issuing reports on how dangerous the fiscal cliff was, that you could, they don't call it dangerous. They say you're going to have a recession if you go over the fiscal cliff, basically. So they didn't. And so now no news on the fiscal cliff. So, we'll see. Amazing how the marketing machine works. We need to get way better at it. But this is the basic, this is some of the key data all in one place. You can see the comparison. And just for a little historical perspective, the unemployment rate, the historical average over like the last, like the post-World War II is like 5.8, if I remember right. From like 1990, it's like 5.6. So this is very low unemployment here at 3.9. All right, not going to read all these. If you look at what's going well and what isn't, there is a ton that's going well. There is a ton that's doing okay. And there is some red, which is the inflation primarily, and then the Republican vaccination rate. Those are sort of the two big red measures that are important. If we could fix the inflation, fix the Republican vaccination rate, those are the two key levers I would love to be able to address. Yellow, you've got more like just the jobs market is not fully recovered, and it's an uneven recovery, meaning if you have a lower education, chances are the percent jobs are you're still a greater percent below the pre-crisis level. Whereas college diplomas and up, those people are actually, there are more of those jobs. Those jobs have fully recovered and then some. I looked at it a couple of months ago, the people without a high school diploma, the number of jobs was like still about 10% down from the pre-crisis level. Based on education, what else do we have here? So yeah, most of this, the ports are processing record volumes. They're just struggling to keep up with demand. So good for them to be able to crank through all this demand for goods. At the same time, though, they could be doing more. The economy might, in theory, be growing faster if you had more throughput through the ports and with less inflation. That's why they call it a bottleneck or supply constraint. All that stuff getting backed up is causing the prices to go up. And then the budget deficit is, we talked about, a sort of a mixed bag where it's great that we like to think of it as it's good that it's lower, but at the same time, it is a headwind to growth when you kind of putting your MMT cap on for a second, you're taking that boost out of you're not injecting as much money into the private sector, it's going to slow down. And the other stuff is all green over here is unemployment rate, jobs creation, goods demand, stock market, household net worth. Almost any wealth measure is in fantastic shape right now. Vaccines are very available. You can make an appointment at Walgreens. It's free. And the forecasts are tremendous. They're very positive economic forecasts. There's a lot of good going on right now, too.
The vaccines are better than free here in Chicago.
Are they paying people
if I
to
wasn't
get it?
vaccinated, I could call up the city and then come to my house and vaccinate me and my friends. And for the Pfizer, we'd get $50 gift cards each time we get a vaccination on the first two.
Wow.
No gift cards for a booster, though.
That's amazing. That's a great idea. Whatever it takes.
Yeah, whatever we do. And also on the budget deficit cutting, I think that's still more Keynesian than MMT in terms of fiscal policy to boost demand. More Keynesian, I think, or more people would think of it as Keynesian versus MMT. Okay, but
we shall see. We'll let Christine comment. All right, last official subject here before we at least hand over to Christine. I assume I haven't talked to Christine in a little bit. I assume there is we talking MMT or you have a presentation tonight?
I don't have a presentation, but I am willing to talk about it a little bit and try to figure out where we're going to go next with that topic.
Okay. Yeah, sounds good. All right. The checking accounts are up and they've been coming down a little bit, but the lower the income quartile, the lower income group, the higher percentage-wise they are. And you got a little table here with some of the data that's shown in the graph. But if you're a wealthier family, your checking account's up more, dollar-wise, obviously, but percentage-wise, it's a little bit higher. And this is because of the Recovery Act, the child tax credit payments. So there's families with kids are getting either $250 or $300 a month per kid, depending on the age of the kid. That happened for the last 6 months of 2021, and then the other 6 months will be part of the tax return when it's filed, but then it ends, or it doesn't end. That's the incremental amount. They'll go back to where they were before. So this 250 to 300 is not, it wasn't zero before. It's bigger. I don't remember the exact amount that was in the original 100 or 150, but it also expanded eligibility, meaning more people were qualified to get that tax credit.
And it
You
came
can
as a
see these-
monthly
yeah,
check,
go ahead.
not as you didn't have to wait for your tax return.
Right. But Biden didn't sign them, right? It doesn't say Joe, courtesy of the Democratic Party, Joe Biden. Another marketing opportunity lost, but hey, the child tax credits. Okay, so you can see here these big stimulus programs. I'm guessing CARES Act was first, right? 2 trillion, and then this one was the 800 or 900 billion at the end of the
900 billion at the
administration,
end
right?
of 2020, in
Yep.
December 2020.
And there's the Relief Act from Biden a few months later. So that's what bumped these up, and now they're coming back down, and we'll see. Like you can see, they fell before. We'll see if anything comes up, and that there isn't anything on the horizon in terms of much larger. Build Back Better, if it's passed, does extend this child tax credit for a year. I think it's a year extension. But again, that one's hung up in the Senate. We'll see if it's going to pass. But this is a study that J.P. Morgan Chase did, looking at their bank accounts and sort of projecting that out for the U.S. But this is at least maybe, I'm not sure they projected it for the U.S. I guess they're saying, considering J.P. Morgan is a $2 trillion bank. I didn't catch how many checking accounts they have, but you can assume it's quite a few to add up to 2 trillion in assets. There is I'm sure it's representative. This is some stuff from, if you're looking for interesting graphics, I'd say they bat 500, but the Center for American Progress will put together some winners on this. If you follow them on Twitter, you'll see these graphics come through, or you go onto their site and check it, and you can share some of them, but they get into the details on some of the policies, and they have a nice production quality that they put on this stuff. It's pretty. So 3.5 million children lifted out of poverty, 41% drop in child poverty, if extended long term. Big drop in food insecurity for low income families, and also that you're putting a lot of money in the economy and they spend it on stuff. They buy stuff at the store, they buy stuff for their kids. It's been a big win policy wise. Here's another one that said, what did people spend the child tax credits on? Food, utilities, rent, mortgage, clothing, education, vehicle payments. I mean, this is stuff that stimulates the economy, less so paying down debt. Savings and investments also not a big, that's not going to drive the economy in the short run. It's these big guys up here that are spending right into the economy, child care, and other. Notice in here, there is not a lot of jewelry. I don't see luxury, investments, boats. I guess vehicle payments could include a boat, but bottom line is these are people that can use the money and put it to use in the economy. Very high multiplier on this kind of a you can call it spending, you can call it a tax cut, however you want to phrase it. This is what's in the infrastructure bill. We've shared this slide before, so you get a sense of how much money is being spent in each of these major buckets of that $1 trillion. And Carl and I mentioned before, even though they call it the $1 trillion investment or $1 trillion bill, we were already spending somewhere close to 100 billion a year on infrastructure, 80 to 100 billion. So let's use 80 as a round number. So the CBO, when they analyzed this, they said this bill's only, even though they called it the $1 trillion bill, it's only going to add about 250 billion over a decade to the budget deficit, and that's because of the baseline of spend they already had. So it wasn't as large a bill. You can call it $1 trillion to market it if you want on the positive, but behind the scenes, the CBO is saying, yeah, but you're already spending 800-ish, so it's not really $1 trillion of incremental spend adding to the budget deficit. This is Build Back Better, and last month we shared about 10 other slides underneath this that had the details of each of these color-coded buckets on here and what's in it. So if you're interested in that, take a look at last month's presentation. But this at least gives you a sense of the major categories. It's almost entirely paid for. The CBO has an estimate of the budget addition that's very small, like 160 billion if you factor in tax enforcement. It was interesting, the CBO said, we think this thing's going to add 367 billion total over 10 years, and they actually had an estimate in their scoring. It said, we're not scoring the tax enforcement, but if you did, we think it's 207 billion, which I love. So, okay, it's there. So that's your 367 minus 207 is 160 billion total. 16 billion a year, as Carl said earlier, is a rounding error in our $4 trillion plus spending side of our budget. So it's paid for substantially. It's close enough to brag about as paid for. Paid for with, pardon me, taxes on the wealthy, business taxes, individual taxes for the wealthy, some healthcare taxes, corporate, not, and some, a couple other things, but for the most part, paid for by taxes on the top 1%. There's plenty of money, believe me, in the top 1% that you can raise their taxes and they'll still do quite fine. A statistic I like to share on Twitter is that if the top 1% were forced to pay off the debt held by the public, which is 20-something trillion dollars, they'd still have 7 times more net worth than the bottom 50% of the population. So they'll be okay. Even if they paid off all the national debt or all the debt held by the public, which is most of the national debt, they would still have 7 times the net worth of the bottom 50%. So don't
which for the
worry
record,
about them too much.
The joke is, for the record, if they actually did that, the financial system would collapse. But besides that,
definitely true.
We'd be fine.
Right, other than the financial system crashing. But the point is, there's so much money in the top 1% that if you raise their taxes dramatically over, say, 10 or 20 years, you don't need to worry about deficits anymore. And they can afford it very well. In fact, their net worth may still rise quite a bit depending on what the stock market does. So the idea that there's just not enough money at the top, that Republicans like to spread this word that there's just not enough money to tax the rich to handle our deficit problems, that's just not true. It's there. The Build Back Better Act is distributed as you would expect, with the greater benefits going to the lower quintiles and then taking money from the top 1%, the top 0.1%. Every other group, even the top, it takes a little bit from the top 20%, gives it to the bottom 80%. This is what progressive policy does. You raise taxes on the rich and you spend on the poor. That's what Build Back Better does. And you can imagine the Trump tax cuts were like the mirror image of this. They were, the bottom groups got, or not exactly the mirror image, but the bottom groups got very small benefits. Depending on certain assumptions you make, they may actually, in some cases, have lost money. But the top 1% benefited the most. So it's definitely, flatten out this stuff on the left side and then bump up the stuff above zero on the right-hand side. I took some of the charts that are in here and created this Twitter piece right here. So if you want, it says the Biden boom. If you want kind of a lot of these slides already packaged for you in a Twitter thread, so it's a list of, and it's a link, all you do is go there and you can just share it. And it has a bunch of the slides that are in this presentation. You got that right there. The other ones are older. That'll give you some background, but this is another one I love to share, is the Why a Republican President So Bad for the Economy. And it's got kind of the history of how much better Democrats are for the economy than Republicans. It isn't close. Democrats are far, far ahead. Like, for example, job creation is 2.5 times faster under Democrats historically. And you can see the same with all the citations here in this Wikipedia article. It's getting built out now. I started the article about a year ago, I think, and it's a lot of other people have started contributing to it now. It's still a little messy looking, but it's got all the data and the sources you would need to understand exactly, give you a lot of talking points for the Democratic argument right there. So there you go. So you have a lot of tools from us, and that's it for the piece from me and Carl.